Hello, this is Brandon, Bradshaw and Will Wealth Management. In our last video with Paul, we discussed taxes, and he asked the question whether tax-free is the same as a Roth. And yes, a Roth is tax-free, but I'm going to expound on that a little bit today because not everything that is labeled tax-free is truly totally tax-free. So in a previous video, we discussed the three basic tax buckets, which are taxable, tax deferred, and tax-free. And in the taxable bucket, this is a bucket where each year you get a 1099, the love letter from the IRS where you owe taxes. And typically in this bucket, you might have CDs, maybe stocks, bonds, mutual funds. Then we have the tax deferred bucket, and this is where the majority of Americans have most of their savings. And so in here we might have IRA, 401k, 403b, and then also non-qualified annuity. Now with this bucket, you are deferring taxes. You can't touch it before 59 and a half without a 10% penalty. And now you have to start taking it out at 72. It was 70 and a half. Now it's age 72. If you don't start taking it out at that age, you get a 50% penalty. So now we're going to the final bucket, and we call this the tax-free bucket. But for this, we're going to actually break this down into two parts. So first, I'm going to use the bucket I call income tax-free side of it. And then in this would be municipal bonds. Now a lot of people put municipal bonds in the tax-free bucket, and it is true that it's free of federal income tax. Now depending on what states that you purchase them from, it may or may not be free of state income tax. But you may have to pay capital gains tax on the municipal bond, and you also will have to, it counts as far as provisional income. So the other side over here, this would be totally tax-free income during your life. So on this side, we have the Roth, and that's the biggest thing out here. You don't get to deduct your premiums when you put it into the Roth, but it is totally tax-free when you take it out. Something else in this is a health savings account. This account, you actually get to deduct the premiums when you put it in, and when you take it out for credible health insurance expenses that are allowed by the IRS, it's also tax-free on that side. And then finally we have life insurance. Now if this is designed properly, then the cash value that you take out in retirement can be totally tax-free. And whereas the Roth has a limitation of how much you can put in each year, life insurance, you're not limited by that. In life insurance, the proceeds of the death benefit are income tax-free to the beneficiary, as well as the cash value during your lifetime being tax-free. So to be totally tax-free, you need to be free of state tax, free of federal tax, free of capital gains tax, and also it doesn't count toward provisional income. That's something a lot of people don't think about, but provisional income for seniors is what you calculate to see if your Social Security is taxable or not. And Social Security can be taxed up to 85%. So this can be very, very important for seniors, is to limit the amount of provisional income. And then we're going to actually add one other bucket here. If you're higher net worth, all this is going to be income tax-free during your lifetime. HSA, if you passed away, your spouse could get that and not have to pay tax. But if you're of higher net worth, you may wonder about the taxes to your beneficiaries, and those can be taken care of in different amount of trust. So trust can take care of that, but that's for the higher net worth. So during your lifetime, we have three main tax buckets that we can put all your investments in. These are taxable, tax deferred, and tax free. Now typically you want to move from left to right. You want to get as much in the tax free bucket as possible, but it is a good idea to be tax deferred. And there are some benefits in each bucket that we look at. For instance, in the taxable bucket, you are taxed if you sell a stock at the capital gains rate, which is typically lower than the ordinary tax rate that you would pay in tax deferred. Also in this bucket, you get what's called a step up in basis under current law. And what this means is if you have a highly appreciated asset, say you bought a stock and it was worth $10,000, and at your death it had grown and now it's worth $100,000. Well, your beneficiaries will get to step up to that $100,000 basis, and so they would only pay tax on any growth above this amount. So that can be a good benefit there too. Also in this bucket, you can own these items jointly, where the other ones have to be owned in individual. Now when we move over to tax deferred, obviously the benefit there is you're not having to pay tax until you take it out. Now that's kind of a catch-22. It's great, and you'd rather defer it as long as possible, but you do have to keep in mind that when you tax defer, it's basically like the IRS having a lien on it, because at some point you are going to have to pay tax on that. One advice I would give for 401ks and 403bs is if you're in a company that gives you a match, you always want to participate up to that match, because that's free money. But beyond that, it may be a good idea to consider, instead of putting more into the tax deferred bucket, to put it into tax free, because most Americans end up with the majority of their money in this tax deferred bucket, and it ends up being a ticking time bomb when you retire. So then you want to end up with tax free. Now with the tax free bucket, Roth is the #1 investment vehicle in this bucket, and it is totally tax free. You don't get a deduction when you put it in, but on the back end when you take it out, it is tax free. But you're limited on how much can go in each year. You have to have earned income to qualify. That means you have to have working income from employment, and you're limited to $6,000 per individual, and then $7,000 if you're over age 50. HSA and life insurance are other ways to get money into the tax-free bucket. So generally, you do want to move from left to right, but you do want to be tax diversified. And in future videos, if you're really concerned about rising tax rates, which that is a very high possibility, then obviously it's great to get more into the tax-free bucket. But you want to do this in a very orderly manner so that you don't end up paying too much taxes too soon. So we'll look at that in a future video. Thank you.